Few stocks have been hotter than Nvidia over the past year. Shares of the AI chip maker have more than tripled over the past 12 months, turning Nvidia into the third most valuable company in America. Now imagine if you took those gains in Nvidia and turbocharged them. That's what the Granite Shares Long Nvidia 2X Daily ETF, ticker symbol NVDL, does. NVDL is up almost 500% over the past year. And since its launch on December 16th, 2022, less than a year and a half ago, it's up more than 1,000%. You heard that right. If you bought NVDL when it launched, you would have almost 10x'd your money. But of course, as they say in financial markets, past performance is no guarantee of future results. So before you even consider buying into this high-flying ETF, there are things you need to know, including the risks that come with owning such a volatile fund. In this video, we're going to break it all down with the help of the perfect guest, Will Rind, founder and CEO of Granite Shares, the firm that created and manages NVDL. So without further ado, let's get into it. Will, thanks so much for joining me.
Samit, great to talk to you again.
Absolutely. So Will, your company manages a bunch of what are known as leveraged single stock ETFs. Can you explain what those are?
Yeah, sure. So these are leveraged ETFs that provide exposure to popular companies. Typically, it's 2 times leverage or 200% leverage to popular companies such as Nvidia, such as Amazon, Microsoft, AMD, etc. We also have some inverse or short ETFs. And again, those can be leveraged, short, or unleveraged, but just providing 2x leverage or unleveraged to the short side or aiming to profit from drops in share prices.
Just to provide a little bit of context, Will, leveraged ETFs have been around a while, but leveraged single stock ETFs are relatively new in the US. Isn't that right?
That's right. So leveraged ETFs are nothing new. They've been around for well over a decade. And typically, those all started out with leveraged exposure to popular indexes that people would know, such as the S&P 500 or the NASDAQ, in both the equity and the fixed income world. And then people started to add leverage on other particular asset classes, such as commodities. So a distant cousin, perhaps, to leverage single stock ETFs would be leverage on single assets like oil or like gold in the commodity space. But leverage single stock is somewhat of a new phenomenon. It's a new category that was pioneered by Granite Shares and some other firms about 2 years ago now. So it has still relatively new in the grand scheme of things, but has proved really, really popular because it provides that built-in leverage to single stocks that people can buy, obviously, in their brokerage account, just like any other ETF.
How do leveraged ETFs provide leverage, Will? When most investors think about leverage, they think about opening a margin account at a brokerage firm and then using borrowed money to buy extra stock. How do leveraged ETFs get their leverage?
So they get their leverage through derivative contracts. Typically, those are arrangements made with investment banks or other broker-dealers, whereby those broker-dealers or those banks provide financing to the ETF to enable the ETF to obtain 2x exposure to a particular stock or a particular asset class. So in a way, what the ETF is doing is disrupting or replacing that traditional margin mechanism at broker-dealers by offering a product that's cheaper, that's much more scalable and much more efficient than traditional margin. And like I said, you never have to get a margin call when you're in the ETF. You just buy that particular product and sell it. You're in control, not the broker.
Are there limits to how much leverage that ETFs can provide? You mentioned that you have products that offer 2x leverage, but I know there's also products on the market that offer 3x leverage.
That's right. So the limit is 2x leverage. So the 3x is a bit of a ETF history, if you will. So they were sort of grandfathered in from a previous regulatory regime. But now any company such as Granite Shares that's listing or trying to launch new leveraged ETFs, the maximum amount is 2 times or 2x.
That's great. So let's get into some specific ETFs that you manage, Will. The most popular by far is NVDL, your 2x Nvidia ETF. Can you tell us about this fund?
Yeah, so NVDL is the ticker code which provides 2x leverage to Nvidia, the obviously market-leading AI company. And that's really just been a huge success. It's about $2 billion worth of assets under management. It can trade some, really obscene amounts every day, and is one of the most traded ETFs now in the market, not just in the Granite Shares stable, but across our platform of leveraged single stocks. We will trade typically somewhere in the region of $700 to $1 billion a day now in terms of volume. But Nvidia or NVDL has been the most popular one we've had. Second most popular one for us is the 2x Coinbase, or CONL or CONL. That's been hugely popular as well, with the resurgence in interest in Bitcoin. But definitely AI still reigns supreme in terms of investor interest, and 2x Nvidia has something that's really captured the zeitgeist of investors looking for exposure, direct exposure, and highly concentrated exposure to AI.
Absolutely. And NVDL has performed phenomenally over the past year and a half or so. And it's an example of the best case scenario when it comes to leveraged ETFs. But of course, things don't always go so well, Will. So can you talk about some of the risks associated with leveraged ETFs? And in particular, can you touch on how daily rebalancing impacts returns?
Sure. So it's not all great, as you rightly point out, that double the leverage means double the risk and double the return, but also double the potential for loss. So if the stock goes up and you're 2x leveraged against it, and let's say the Nvidia stock returns 5% for the day and you're 2x leveraged to NVDL and it returns 10%, the opposite is true. So if Nvidia goes down by 5% in a day, NVDL would lose 10% or go down by 10% in a day. So leverage works both ways. It's great when it works for you, but it can hurt you when it works against you. And people have to be very careful about using any kind of leverage, whether it's leveraged ETFs or whether it's mortgages for your house. Whenever you use a product that contains leverage, be aware of the risks. The daily rebalancing means that sometimes these are referred to leveraged ETFs as constant leverage ETFs. And what that means is that any day you buy it, you get the stated investment leverage amount, which in our case could be 2x or it could be minus 2x, but it's 2x leverage. And so in order to do that, at the end of each day, the portfolio is rebalanced so that the start of the next trading day, the portfolio is fully hedged and is at that or achieved that target leverage factor. So throughout the course of that trading day, the portfolio will be 2x leveraged. Now, the reason why that can be confusing sometimes to people when you look at the return profile over a long period of time is that is not a linear return. In other words, if you take point A to point B, so let's say a month, and you start with Nvidia's return on first day of the month, and then you end on the last day of the month, and you apply 2 times leverage to that, and let's say the stock did 10% return for the month, then a linear return would give you 20% return at the end of the month. Leveraged ETFs are different because they're doing that every single day. So there's a compounding effect that's built into that, which means that your return could multiply more than that 2x linear return, or it could be less than that 2x linear return. And sometimes an easy way to think about it is that what these products are really good at and where they thrive is where there's a trending environment. So when a stock is trending, clearly if you're levered long, you want that to be trending in a positive direction, then you can end up outperforming the 2x of the underlying stock return, the linear return. But consequently, if the stock goes down, you can end up underperforming because the inverse is true. But the market environment that these products don't like is where you have a choppy market, choppy environment where the stock's going up one day, down the next day, up one day, down the next day. And there the leverage actually erodes the value or the NAV of the product. So what you end up with is some decay in terms of the AUM, over time. So that's really the worst case scenario from a levered investor's perspective. But what they like is trending environments where the stock is trending in one particular direction. And, people just need to understand how that leverage and how that rebalancing works.
Great color. So the main point is that the 2x refers to the daily movement of Nvidia. So if the stock goes up 1% in a given day, NVDL should go up by 2%, but that doesn't extend to longer time horizons like 1 week or 1 month.
Exactly. Like almost certainly it won't be 2x, exactly 2x over 1 month, a year, 5 years, etc. It will deviate from that. There's a path dependency to it.
Given everything you just talked about, Will, are leveraged single stock ETFs only for traders? And if so, how long can they be safely held for?
It depends, obviously, what you mean by a trader. I mean, I wouldn't say that they're just for day trading. I would say that they are for investors who like to be active and monitor their portfolios on a daily basis. And I think regardless of what your sort of investment objective is, it's not for us to say that they should only be used in one particular way. But the way that we like to talk about it is that typically these are for high conviction investors, highly engaged investors, and people who are monitoring their portfolios on a daily basis.
You know, Will, we've talked a lot about the mechanics of these leveraged ETFs. What's your take on Nvidia, the company? Do you still see a lot of upside in the stock?
I do. I mean, I think that it's still early days for AI, and the performance and potential of a company like Nvidia is really yet to be fulfilled. I think on the streets, almost every analyst that covers Nvidia is still bullish. In other words, everybody has it as a buy. There's maybe a couple of holds in there, but everybody's a buy. So no one's selling. And I think that, if you think about not just Nvidia, but any stock, it's sometimes helpful to maybe take a step back and think about, is this a bigger company in 5 years' time than it is today? And I think the answer with Nvidia is almost certainly yes. AI is real. Nvidia is the company that's making the most out of AI today, but look at the amount of money that major corporations are spending on AI, and that's only going to increase. It's hundreds of billions of dollars. Nvidia now or today is the biggest beneficiary, and I think they are, in terms of market leading position, they're so far out in front that it's going to take a long time for people to catch up, even if they can. But that being said, there's going to be more than just one winner in the AI race, but I think Nvidia is a bigger company 5 years from now than it is today. And AI, to me, is the most important trend for people to be aware of in investing today.
Before I let you go, Will, is there anything else you want to add? Maybe you could tell us about your whole lineup of single stock ETFs. What are the other popular ones other than NVDL? And is there the chance that we could see single stock ETFs tied to meme stocks like GameStop in the future?
Yeah, I mean, it's another all-time high in the market today, as we're talking about. We've got GameStop and the other meme stocks back in full focus with the re-emergence of Roaring Kitty. And so all of this feels like it did, a few years ago. But this time around, what that does to us, although we don't have any levered ETFs on GameStop or on AMC or some of these other meme names, is that I think it signals that there's a renewed or an enthusiasm for investing, enthusiasm for trading that's really come back to the forefront. And GameStop and some of these other meme stocks are just one expression of that. But we've certainly seen a big pickup, a big interest or demand for leveraged single stock ETFs, just more broadly. And yeah, outside of Nvidia, I mentioned Coinbase, which has been a huge one for us. That's 2x Coinbase, the CONL, or CONL is the ticker. Because again, outside of AI, crypto and particularly Bitcoin, with its resurgence, has really galvanized a lot of interest with investors. And then outside those two names in particular, it's your kind of classic, mega tech names. It's your Teslas with TSLR. It's your Amazons with AMZZ, Microsofts, etc. And I think one other AI stock to keep an eye on is AMD. And so we have a 2x AMD, AMDL as the ticker code. And so that one we'll see if that can rival NVIDIA and become, a big competitor to NVIDIA in the AI race. But if people go on our website, graniteshares.com, they can look at the lineup of products we have, not just on the long side, but also the short side. And I'm sure, hopefully you'll find some single stocks in there that will appeal.
Fantastic. Well, a ton of great information, Will. Thanks so much for your time.
Thank you, Sumi. Always a pleasure to talk to you.
Well, there you have it. I hope you now understand NVDL a little bit better. As Will said, this is a much riskier investment than just owning Nvidia stock. The day-to-day movements of this ETF are going to be 2 times that of Nvidia, a stock that's already pretty volatile. And then on top of that, you have the compounding effect of daily rebalancing. In case you still don't understand what that means after watching my interview with Will, here's a quick and easy way to understand the concept. Say Nvidia goes up by 10% 3 days in a row. If you own the stock, you'll have a return of 33.1%. Meanwhile, NVDL will go up by 20% each day, resulting in a 72.8% gain. 72.8% is equal to 2.2 times 33.1%. So in this case, you benefited from the compounding effect. You made more than 2 times what you would have made in Nvidia. On the other hand, if Nvidia went down by 10% 3 days in a row, the multiplier would be less than 2x. In this case, you'd lose 1.8 times more in NVDL than in Nvidia stock. There's a third scenario as well, which Will touched on. That's the scenario where Nvidia stays flat. If, for instance, one day Nvidia goes up from $900 per share to $990 per share, a gain of 10%, and then goes back down to $900 the next day, if you own the stock, you'd be flat. You wouldn't have gained or lost money over that 2-day period. But that's not the case for owners of NVDL. The ETF would go up by 20% the first day, say from $40 per share to $48 per share, and then down 18.2% the next day, because it dropped from $990 per share to $900 per share in Nvidia stock is equal to a decline of 9.1%. An 18.2% decline from $48 puts NVDL at $39.27, a loss of almost 2% versus the original $40 share price, even though Nvidia is simply back to its original share price. That's an example of how leveraged ETFs can underperform even if the underlying asset that they track stays flat. So the best scenario for NVDL is if Nvidia stock keeps trending upwards without a lot of drawdowns along the way. If you're bullish on Nvidia and think that's what's going to happen, then NVDL is an extremely aggressive way to express that view. But it's important for you to fully understand the risks that come with this type of ETF. For most investors who are bullish on Nvidia, just owning Nvidia stock is the more appropriate investment. You have to have a very high tolerance for risk to wade into NVDL or any single stock leverage ETF for that matter. Anyway, I hope this video was informative. If you want more content focused on investing, business, and the economy, hit that subscribe button.